Okay, everybody, welcome to the TSP Weekly Update Show. Conan and I are both out of town this weekend and couldn't come up with a good way to get the show put together before both of us went our separate ways. So I'm going to record the show on my own this week. Hopefully, it'll be valuable for you guys. Next weekend, we should be back together Conan will be back in Virginia, and he's going to pull me in, but we should get the show back to normal next week. So in the meantime, what are we going to do this week? It's December, and it's about the time that all the pundits come in and give you their forecast for the following year. So we're going to take a look at the 2023 market forecast for industry, government, IMF is the International Monetary Fund, and what the money managers say is happening in their crystal ball for 2023. And then we're going to take a look at the TSP fund charts, 3-year weekly charts as usual. Okay, so 2023, we didn't get a recession in 2022, so all eyes are on a recession in 2023. It's without a doubt between recession and inflation. There isn't a whole lot of talk about pretty much anything else. It's all how and when we're going to get to recession and how bad it's going to be. Okay, so the bulls. These are. I got this. I pulled these screenshots, the next several from Financial Samurai. This is the link right here. And basically, they compiled a bunch of lists of some of the bulls, some of the bears, and some of the neutral, financial services companies and their projections into 2023. So, J.P. Morgan, one of the big ones, right? Their projection for 23. This is at the end of 23 for the S&P 500, 4,200. Right, which is pretty close to where we are now, and that's going to be a theme throughout this presentation. So J.P. Morgan has us about 4,200 by the end of next year on the S&P 500, and they say we expect market volatility to remain elevated. Right, so the VIX averaging around 25, which VIX is about 22 right now, so not too far. And as we know, when the VIX goes up, the S&P 500 goes down. So with another round of declines in equities, especially after the run-up into year-end that we've been calling for, and the S&P multiple approaching 20 times. So more precisely, in the first half of 23, we expect the S&P to retest this year's lows, right, the October lows, as the Fed over-tightens into weaker fundamentals. This sell-off, combined with disinflation, okay, so an easing of inflation, rising unemployment, and declining corporate sentiment should be enough for the Fed to start signaling a pivot, which we've talked about before. Whether or not those things actually are enough to get the Fed to pivot, we shall see. Subsequently, driving an asset recovery, right? So when the Fed pivots, the idea is that the stock market's going to recover and push the S&P 500 to 4,200 by the end of 2023. Okay. So what is that basically calling for? A decline in the first half, a recovery in the second half, back to pretty much where we are right now. Okay. Jefferies, same number, 4,200. So in 2023, we expect bond markets will be probing for the Fed's terminal rate, while equity markets will be in no man's land. So earnings fall and growth and margins disappoint. So not too much different, shorter, but not too much different than the J.P. Morgan, thoughts. And again, don't forget, these are the bulls. Okay, these are the bulls. BMO 4,300, right? A little bit higher by the end of next year. We still expect a December S&P rally, even if stocks do not hit our 4,300 price target, which was their price target for 2022. Unfortunately, we believe it will be difficult for stocks to finish 2023 much higher than current and anticipated levels, given the ongoing tug-of-war between Fed messaging and market expectations. So the bulls are all kind of talking about the same things. We got Wells Fargo, 43 to 4,500. This was it came out in August that was their prediction for 2023. Our single and consistent message since early 2022 has been to play defensive in portfolios, which practically means making patience and quality the daily watchwords. Holding tightly to those words implies that long-term investors in particular can use patience to turn time potentially to an advantage. As we await an eventual economic recovery, the long-term investor can use available cash to add incrementally in a disciplined way to the portfolio. So they're talking about a dollar cost averaging type of approach, and that's fine, but you're seeing here long-term investors and patience and quality, right, as the buzz as the buzzwords. Excuse me. Deutsche Bank has us at 4,500 by the end of next year. Equity markets projected to move higher in the near term, plunge as U.S. recession hits, and then recover fairly quickly. So again, same pretty much as the other bulls. We see S&P 500 at 4,500 in the first half, down more than 25% in Q3, and then back up to 4,500 by the end of 2023. So a lot, the majority of the bulls are seeing a steep decline in the first half and a recovery back to where we are now in the second half. Luthold Group 5,000 by the end of 2023. Jim Paulson, chief investment strategist, says the lows are in. So he sees the start of a new bull market over the next 12 months. So the lows are in, meaning the October lows are in. He says valuation should increase in the first year of a bull market and often has some of the biggest gains. So these guys are the most bullish by far to actually come out and say the lows are in, because nobody else is saying that. Certainly not in the neutral or the bears, and they're the only ones in the bulls that are saying that. Okay. Bears. What are the bears saying? Barclays. They got us at 36.75 by the end of next year, right? We acknowledge some upside risks to our scenario analysis given post-peak inflation, strong consumer balance sheets, and resilient labor market, right, which are the positive influences. However, current multiples are baking in a sharp moderation in inflation and ultimately a soft landing, which we continue to believe is a low probability. So they think the market is pricing in inflation coming down and a soft landing, and they don't think that's going to happen. So they have us at 36.75 by the end of next year. Society General, 3,800, bearish, but not as bearish as their 2022. They think that returns profile should be much better in 23 as Fed hiking nears an end for this cycle. Our hard soft landing scenarios sees earnings growth rebounding to 0% in 2023. We expect the index to trade in a wide range as we see negative profit growth in the first half of 23, a Fed pivot in June of 23, China reopening in Q3, and U.S. recession in Q4. So that's why it's in the bearish column. They're not looking for a very good year in 2023. But again, the roller coaster. It's just that they don't expect us coming back up to the prior highs like the bulls do. Capital Economics 3,800. We expect global economic growth to disappoint and the world to slip into recession, resulting in more pain for global equities and corporate bonds. But we don't anticipate a particularly prolonged downturn from here. So by mid-23, the worst may be behind us, and risky assets could, in our view, start to rally again in a more sustained basis. So again, they're really all saying the same thing. They're looking for a very tough first half and a rally in the second half. Morgan Stanley, 3,900. This leaves us 16% below consensus on the 23 earnings per share in our base case and down 11% from a year-over-year growth standpoint. After what's left of this current tactical rally, right, that we're in right now, we see the S&P 500 discounting the 23 earnings risk sometime in the first 3 quarters of next year via a 3,000 to 3,300 price trough. So they're calling for the price trough, which would be the low for next year, between 3,000 and 3,300. So we think this occurs in advance of the eventual trough in earnings, which is typical for earnings recessions. So they're focused on an earnings recession next year. They think price comes down to 3,000 to 3,300 on the S&P 500 before earnings actually bottoms. UBS has us at about 3,900 by the end of the year. UBS economists forecasting a U.S. recession in second to fourth quarter of next year. The setup for 23 is essentially a race between easing inflation and financial conditions versus the coming hit to growth and earnings. So everybody's talking about the same kinds of things. Everybody sees earnings decreasing next year, and what's going to drive the market, whether it's inflation or earnings, and which drives which, right? History shows that growth and earnings continue to deteriorate into market troughs before financial conditions ease materially. So there's a lot of work to be done before we get to the low in this market. Citi has us at 3,900. Implicit in our view is that multiples tend to expand coming out of recessions as earnings per share in the denominator continues to fall while the market begins pricing in recovery on the other side. Part of this multiple expansion, however, has a rates connection, right? Interest rates. So the monetary policy impulse to lower rates lifts multiples as the economy works its way out of the depths of recession. So the bears are definitely looking for us to be down in the 3,000-ish as a low for next year, and then back up to the high 3,000s by the end of the year. And we get a few that are neutral, right? So Bank of America is calling for 4,000. There's a lot of volatility, right? But our bull case, 4,600, is based on our sell side indicator being as close to a buy signal as it was in the prior market bottoms. Wall Street is bearish, which is bullish. Our bear case from stressing our signals yields 3,000. So they're saying 3,000 at the trough on the downside, and they're expecting to likely end the year at 4,000. Pretty wide range there. Goldman Sachs also has us at 4,000 by the end of the year. The performance of U.S. stocks in 22 was all about painful valuation, derating, but the equity story for 23 will be about the lack of earnings growth, right? That's what a whole bunch of these other companies has talked about. Earnings, lack of earnings growth means earnings decline. Zero earnings growth will match zero appreciation in the S&P 500. As earnings decrease, the S&P 500 will decrease. My old shop where I used to work in New York City, I've never seen the S&P 500 change exactly based on earnings changes. Okay. HSBC has us at 4,000 also. We think valuation headwinds will persist well into 23, and most downside in the coming months will come from slowing profitability, which is slowing earnings. So they're all kind of saying the same thing. Credit Suisse has us at 40.50. Weak, non-recessionary growth and falling inflation. That's pretty interesting. That's what they're calling for 23, a year of weak, non-recessionary growth. So they're not necessarily seeing us in recession, but they're not seeing stocks rallying either. So my other old, all right, RBC has us at 4,100. We think the path to 4,100 is likely to be a choppy one in 23 with a potential retest of the October lows early in the year. As earnings forecasts are cut, Fed policy gets closer to a transition, which means a pivot, and investors digest the onset of a challenging economy. So they're all pretty much saying the same things, whether bears, bulls, or neutral. Okay, so what are America's top CEOs saying about possible recession in 23? This is a really good article from CNBC. I'm not going to go through the whole thing, so you definitely want to check it out. As 2023 approaches and the prospect of a recession looms, corporate America is preparing for a slowdown in consumer spending. CEOs of major companies, including Walmart, GM, joined Squawk Box on Tuesday to talk inflation, interest rates, geopolitics, and what it all means for their outlooks in the new year. And here's what they said. Again, go to that link, check it out. There, it's both in written and in video. It's worth going to take a look at. But the key points, the key takeaways were CEOs from JP Morgan, General Motors, Walmart, United Airlines, and Union Pacific were the ones that were interviewed. They are preparing for an economic slowdown. And they're all big, right? It's financial industry, industrials, retail, airlines, and transports. There's no tech in there, but it's pretty much everything else. So you definitely want to listen to what they're saying. and they are all preparing for economic slowdown. Among the issues cited, rising interest rates, inflation, and geopolitical concerns. Same thing we've been talking about throughout 22. It just seems to be extending into 2023 at this point. So companies are taking a conservative approach to 2023. Okay. So in terms of government and IMF, this is a really interesting video from Wall Street Journal. It's only 4 minutes long. I would definitely check it out. But here's the highlights. So Geeta Gopinath, she is the IMF first deputy managing director. A little synopsis of what she says on the video. She expects average U.S. growth in 2023 will be at 1%. U.S. is very unlikely to avoid recession, so it's very likely, in the opinion of the IMF, the International Monetary Fund, that the U.S. goes into recession in 2023. And she also expects for the unemployment rate in the U.S. to get over 5%. Then we had Glenn Youngkin as the governor of Virginia. What he basically said was substantial declines in expectations for employment, sales, and capital investment. Consumer confidence and sentiment pretty much define a recession. He goes into a recession is not, one person looking at a chart and claiming, declaring a recession. It's much more about consumer confidence and sentiment. He believes we will have a recession and that the Fed has to be nimble in its response, which is interesting because the Fed's ability to be nimble now is probably better than it would have been if the Republicans had taken the Senate. So the Fed is probably in a better position to be able to do more. Whether or not it does things that people want it to do, it's a different story. And of course, as the governor of Virginia, he's saying that this is an opportunity for governors to lead the country through 2023. Then we had David Solomon, who's the CEO of Goldman Sachs. He is calling for slower growth, 1.9% global GDP, right? So U.S. is 1%, global 1.9. He says a soft landing is possible, but it would look something like a 4% inflation rate, which the Fed, their target is 2%, and a terminal rate of 5%, and 1% growth. So it's basically stagflation. You'd get not the worst of any of them, but all of them would be really bad. So you'd have relatively high inflation, relatively high unemployment, and relatively, really 1% really low growth, which is stagflation. So that might be a soft landing, but it wouldn't be a good scenario either. And then he says, as he talks to CEOs, most are cautious and actively preparing for a difficult 2023. And last we had Ron Klain, who's the White House Chief of Staff. He rightly says we're beginning to see some inflation moderation, but the problem is far from behind us. Gas prices are coming down. They're looking at some supply chain improvements, but we still have a strong job market, which is good for the economy on the one hand, but it supports the Fed continuing to raise interest rates. So a strong job market, income is still high, and wages is still going up, which again, good for people, good for the economy, but bad in terms of inflation and the Fed. So we shall see. World's top money managers see double-digit stock gains in 2023. So don't let this slide kind of fool you. Okay, it's all perspective. So Bloomberg survey shows optimism for the year ahead, but worries about stagflation. So some of the world's biggest investors predict that stocks will see low double-digit gains next year, which would bring relief after global equities suffered their worst loss since 2008, amid recent optimism that inflation has peaked and that the Federal Reserve could soon start to change its tone, right, i.e. pivot. 71% of respondents in the Bloomberg survey expect equities to rise versus 19% to decline. For those seeing gains, the average response was a 10% return. So this is a recent article. So it's December 9th. So it's relative to today. So let's say today the S&P is at 4,000, give or take. So if we got a 10% rate of return, we'd be at 4,400. right? Which basically would put it in the bullish camp for next year. It does not get us back up to the new high, to the all-time high at 4,800 and change. That was the top in January 2022. So these guys aren't talking about it, the most bullish, right? Are not talking about us getting back up to the prior highs and keep on going, and the rally continues. They're just talking about um, gains from where we are right now. Okay. Another one, Wall Street surprising consensus forecast for 2023. So kind of interesting. Wall Street strategists looking ahead to 23, and like most years, outlooks contain a degree of similarity from firm to firm, right? But the surprise wrinkle this year is many full year forecasts contain not one, but two distinct predictions about the stock market's path. So this is going to sound very similar to some of the outlooks that we've already looked at. Because not only do a number of firms think stocks will be flat next year, which is what we've seen, many strategists are also calling for this bear market to decline to new lows before a stabilization in the second half of the year. So this is more of the same. We're hearing the same thing. Market drops in the first half of the year, stabilizes, and then starts to recover in the second half of the year. In a note to clients published Thursday, Capital Economics chief market economist John Higgins wrote, "We suspect the S&P will make new cyclical lows by the spring of 23 as a shallow recession gets underway for the U.S." Okay, so they're not calling for a very deep recession. They're calling for a shallow recession. We hit new lows, and then we rebound by the end of next year higher than it is now, right? Higher than it is now is higher than 4,000. But they are not saying that we're going to new all-time highs. So I think this is all pretty, the consensus is certainly there in terms of what's going to happen next year. And this chart is a pretty good graphic of everything that we've talked about so far. This is where I got it from. It's Goldman Sachs Global Investment Research. So I would say this is a visual of everything that we've talked about so far. Here we are at the peak of this rally right now. And so going into next year, the consensus either was that we have a shallow recession. If we have a shallow recession, we come down somewhere above or test that October low into the middle of next year, and then we start moving higher. Okay. So that's the path for if we get somewhere around 4,000 by the end of the year. The alternative to that was the bearish case where people are expecting the market to take out these October lows and say we come down here to the 3,000 to 3,300 area and then stabilize and then have a big recovery into the end of the year. And now we're at 3,750 by the end of the year. So on a percentage basis, these are pretty far off. But in terms of direction, they're exactly the same, right? The first half of the year, either we get a relatively shallow pullback or we get a relatively strong pullback, right? Into the middle of the year, and then the second half of the year, we have a recovery, right? And how high do we recover? Who knows? But nobody's talking about coming back up here to the highs. And everybody's talking about at least some decline in the first half of 2023. So that is pretty much the consensus. That's where we are. If you guys have questions about that, please hit us up. And I'm sure we'll be talking about it more over the next couple of weeks before we begin 2023. Okay, so the bottom line, they're calling for slow growth globally, Fed tightening, high rates of interest, higher unemployment, recession to some degree is very likely, and the bottom to this thing happened early to mid 2023. S&P to end 2023 at around 4,000 ish, somewhere 3,800 to 4,200 maybe. We shall see. They're never right. These forecasts at the beginning of the year are never right because they never take into account the unknown unknowns, which they can't, of course. This time last year, nobody was taking into account either the war in Ukraine or the massive inflation that we had this year. So take it as a take it for what it's worth, but I wouldn't bet the bank on, even though the consensus is very strong, I wouldn't bet the bank on it because there are other people that are calling for a giant melt up. So again, the charts will dictate. Okay, TSP fund charts. Let's see, like we always say, this is the 3-year weekly chart of the C fund, and the blue line is the 20-week moving average line. So all the way back here from COVID, as soon as we got back above that 20-week moving average line, the line acted as support all the way along until January of 2022 when support failed, and we've been in a downtrend ever since. So we are still in the downtrend. If you connected these highs, we are right at the bumping up against resistance at that trend line. And you can see this week is, I'm recording the show a little bit early on Friday, but if it closes where it is right now, we took out the losses, or took out all the gains from last week and the week before, but it looks like price is trying to find some support there at that 200-week moving average. We got RSI right at the 50 line, but declining, and MACD cross positive, but you can see that this week the histogram is starting to roll over. So I wouldn't be a buyer of it here. This is a better position to be short, actually. If we get below that blue line, that's pretty much it. We're going to come down and test this prior low. If we continue to get support above this blue line, because we've had it for 1, 2, 3, 4, 5 weeks. I mean, we've been above the 20-week moving average line for 5 weeks. So the longer we're there, the more likely price will find support and move in this direction. But honestly, it's not looking good right now. S fund, same kind of thing. Broke below it really hard back in November 2021. Haven't been able to get above it. We had a little overshoot here during that summer rally, but for the most part, the 20-week moving average line has acted as resistance ever since we lost that level back here in November of 21. And this was a rough week because we took out the last several weeks of gains to flat along that 20-week moving average line. You got RSI below 50, MACD histogram was pretty weak, where we haven't crossed back down negative yet, but we are on a weekly time frame. So S fund is looking worse than the C fund for sure. Okay. I fund has exploded higher ever since this big week up through that 20-week moving average line, and we had gains continuing. Like we've been talking about, these gains will continue as long as the dollar continues to decline. So you definitely want to watch the chart of the dollar, because if the dollar reverses and starts moving higher again, the F fund is definitely going to start moving down again. But for the time being, we had it was a pretty solid week this week compared to the C and the S funds. We got a pretty not much of a loss on the I fund, so actually looking pretty good. We are above the 50 level on RSI, and we're still increasing here on the histogram on the MACD. So definitely not looking too bad on the I fund, but again, it's dependent on the dollar. F fund at a huge breakout right here. We had several weeks of gains, and then finally we got a breakout above that 20-week moving average line, and we got a little bit of a pullback going on this week here. So, but we got RSI up to 50 and hasn't been able to get really above it. We had a cross on the MACD, and the histogram is continuing to move higher. So as long as we stay above that 20-week moving average line, the F fund is still in pretty good shape. Okay. That is all I got. Hopefully that was valuable. I know we didn't have the back and forth that we usually have on the show, but we will be back at it next week. That is all I got. If you guys have questions, please post them to comments. Definitely hit the bell icon on the YouTube. And that is that is all I got. Hope you guys had a great weekend, and we will talk to you next week.